Welcome to this explainer. Today, we're completely stripping away all that complex financial jargon and constructing a true masterclass on building wealth, literally from the ground up. If you've ever felt totally overwhelmed by financial advice, or maybe felt like the rules of money were locked away in some secret club that you just didn't have access to, well, you're in exactly the right place. We are going to build your personal pyramid of wealth.
Okay, let's dive right into this. You've probably heard this classic brain teaser before. Would you rather take a cool $3 million in cold hard cash today or a single penny that doubles in value every single day for just 31 days? Seriously, lock in your answer right now. Keep it in your head. We're going to reveal the shocking mathematical reality of this a bit later in the explainer. And trust me on this, it'll completely redefine how you look at your financial future.
So, here's our roadmap for today. We'll be moving rapidly through 6 structured steps. Master your money mindset, the wealth management blueprint, the magic of compounding, escape the cash trap, buy assets, not liabilities, and finally, build high-value skills. These steps actively scaffold together to form a foolproof pyramid for financial independence.
Let's kick things off with step 1, master your money mindset.
Look, if you're feeling a deep anxiety that you're somehow falling behind your peers financially, I really want to validate that for you right now. It is an incredibly common feeling, especially today. But before we get into the heavy math of money, we absolutely have to fix the psychology. All happiness is the gap between expectations and reality. You see, feeling broke or unsuccessful, it's very rarely about your actual reality. It's almost always tied to outsized expectations. Decades ago, we just compare ourselves to our next-door neighbors. But today, we compare ourselves to a highly curated, wildly unrealistic social media algorithm. You're literally comparing your normal everyday Tuesday to a billionaire's highlight reel. To build real wealth, you have to disconnect your financial goals from this exhausting desire to impress strangers.
That brings us to step 2, the wealth management blueprint.
Once your mindset is locked in, we move away from psychology and straight into the daily mechanics. This is where you establish total, absolute control over your paycheck, rather than letting your paycheck control you. Think of this as a highly effective, sort of gamified system for organizing your income, and it works whether you make $1,000 a month or $10,000. It's called the 25-15-50-10 rule. Let's break that down. 50% of your income is strictly capped for your essentials, stuff like housing, groceries, basic transport. 25% goes strictly to growth, meaning investments that literally make you richer while you're sleeping. 15% is funneled into stability, and that final 10%, that's dedicated to rewards. Because let's be real, if you don't actually enjoy your money, you're going to burn out and abandon the whole system.
Now, what's really interesting about this breakdown is the stability and essentials categories. Your stability fund needs to cover roughly 5 months of your baseline expenses. You want to hold this in a high-yield savings account where it earns a bit of interest but remains instantly accessible. Why? Because stability prevents life's inevitable emergencies like, say, a blown car engine or a sudden job loss from forcing you to sell off your investments at a major loss. Meanwhile, your essentials are strictly for needs. By rigidly capping this at 50%, you actively defend yourself against lifestyle creep. You know, that dangerous trap where your spending magically rises to match every single pay raise you ever get? Yeah, we're putting a stop to that.
All right, moving right along to step 3, the magic of compounding.
Listen closely, because this is the true mathematical engine of wealth creation. Seriously, if you only remember one concept from this entire explainer, let it be this one. We've got 2 investors here. Let's look at Billy first. Billy starts investing at age 20. He puts in a very modest $200 a month for 40 years. So out of his own pocket, he's invested $96,000. Then we have Phil. Phil waits until he's 30 to get started. Realizing he's a bit behind, Phil decides to invest more, $300 a month for 30 years. Out of his own pocket, Phil has put in $108,000. So Phil invested more of his own hard-earned money, right? Logically, he should have a much bigger portfolio by the time they both hit age 60.
But check this out. This brilliantly illustrates the absolute superpower of compounding. Assuming a 10% average annual return, Billy finishes with over $1.26 million. Phil, despite investing significantly more of his own cash, finishes with just over $678,000. Billy invested $12,000 less, but ended up with nearly $600,000 more. It's wild, right? Time in the market is vastly more powerful than timing the market, or even the total principal amount you invest. Basically, every single day you wait to invest is a day compounding is working against you instead of for you.
Which brings us right back to our brain teaser from the very beginning, the $3 million today or the penny that doubles every day for 31 days. If you chose the penny, huge congratulations. By day 31, that single doubling penny explodes into a staggering $10.7 million. I know, it almost seems physically impossible, but that is the undeniable exponential power of compounding over time.
Step 4. Escape the cash trap. So, obviously we know we need to invest, but first we really have to address the biggest wealth illusion in modern society, the idea that hoarding cash makes you safe. Here is the brutal truth of the matter. Cash sitting in your bank account is an active threat to your long-term wealth. It literally loses value over time. While the number on your screen might look the same, or maybe it grows slightly from some tiny bank interest, the actual purchasing power of that money is plummeting because of inflation. When inflation soars and your bank interest lags way behind, keeping uninvested fiat currency is actively burning a hole in your pocket. You aren't playing it safe, you are practically guaranteeing a loss of value.
Let's move to step 5, buy assets, not liabilities.
To stop that inflation erosion, you've got to move your money into protective vehicles. This right here is the fundamental difference between the rich and the middle class. An asset puts money in your pocket over time. A liability takes money out. It is really that simple. The wealthy use their money to buy assets. The middle class? They accumulate liabilities, like heavily financed, brand new cars that lose half their value the second you drive them off the lot, and they mistakenly think they're buying assets.
So, what should you actually buy? Well, here are 6 assets that are infinitely better than holding cash. Number 1, precious metals, like gold and silver, which act as a timeless store of value. Number 2, industrial commodities, like copper or cobalt, which are driven by massive, real-world demand. 3, safe haven currencies, like the Swiss franc, known for incredible geopolitical stability. 4, sovereign guarantees, like U.S. Treasury bonds. 5, value stocks and index funds, offering steady price appreciation and dividends. And finally, number 6, land and real estate, historically one of the most resilient inflation hedges in existence.
Now, let's see how this actually builds into an actionable portfolio for a normal, everyday investor. Listen, you do not need to overcomplicate this. You can capture incredible growth by just setting up a super simple, automated 3-fund portfolio. Step 1. Buy a broad U.S. stock index fund. You can think of this as owning a tiny, tiny slice of all the biggest companies in America. Step 2. Buy an international stock index fund, just to diversify yourself globally. Step 3. Add a bond fund to provide some stability and smooth out those wild, stressful rides of the stock market. You just automate this transfer on payday and you let it run silently in the background.
Finally, we reach step 6, build high-value skills. Okay, once your investments are automated, your only real job is to pour more fuel into the machine. We've reached the very peak of the pyramid here, maximizing your earning potential. Think of this as the ideal chronological progression. In your teens and early 20s, the absolute highest return on investment you will ever get is learning a unique skill stack. Things like coding, copywriting, sales, video editing, skills that literally no one can ever take away from you. Then, in your 20s, you vehemently avoid consumer debt and use those new skills to start a side hustle. As you move into your 30s and beyond, you funnel all that excess cash directly into buying assets and automating your investments.
And this brings us right to the famous cash flow quadrant. On one hand, we have employees and the self-employed. If you're in this camp, your income is strictly capped. Why? Because you're directly trading your time for money, and frankly, you only have so many hours in a day. To build true, expansive wealth, you absolutely must shift to the other side of the equation, becoming a business owner or an investor. Over there, you're leveraging other people's time and other people's money. Your income is suddenly no longer chained to the clock.
So the crucial point here is captured beautifully in this simple quote. Wealth is what you don't see. We are completely conditioned by society to think the person driving the finance luxury car and wearing the flashy designer clothes is wealthy. But true wealth, it isn't the loud display of spending. True wealth is the unspent money. It's the index funds quietly compounding in the background, the rental properties generating monthly cash flow, the businesses running smoothly on systems. Wealth is freedom, guys. It's not a receipt.
Which leaves us with this final, honestly vital question. I want you to take a hard look at your own spending habits today. What is the psychological hole you're trying to fill by buying things you don't really need, just to impress people you probably don't even like? Can you choose to just step off that treadmill today? Stop chasing status, start using the structured steps from this explainer, and begin building true intergenerational freedom instead. Ultimately, the choice and the wealth is entirely in your hands.